Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I'm joined on this Jobs Friday by my three colleagues, two trusted co-hosts, Chris Dorides and Marissa DiNatale. And Dante, you might as well be a co-host. You're on every Jobs Friday, so it's good to have you all. I guess a lot of illness here. We're just talking about this. Marissa's not feeling so well. We won't go into that any detail, but not her 100% self. And Chris, it sounds like you got a cold.
Yeah, something.
Some
yeah. Virus.
Dante, how are you feeling?
Surprisingly, I'm okay. My kids have been sick this week. I'm dodging the bullet so far, so we'll see.
Oh,
I'm
just
with
wait.
You.
Just wait.
I know. My niece and nephew are 6 and 3, and they're constantly sick. And so I feel like every time I see them, I get whatever they have.
Well, my wife's got a bad cold too. She was coughing and sneezing all night. So yeah, but so far I dodged that bullet too. Yeah.
For you.
So, yeah. So far so good. But anyway, sorry about that. We'll see how this goes with everyone under the weather. But the jobs report must have cheered everybody up, right? I mean,
the job market is healthy.
The job market feels pretty good, right? Right, Dante, you want to give us a rundown on the jobs numbers today? This is for the month of March 2023. This is Friday, April 7th. So we got the numbers. So they felt pretty good to me. But what do you think?
Yeah, I would call it maybe the least contentious report we've had in a while. We had some reports that were upside surprises. We had some reports where the surveys tended to diverge a bit, and this one felt like it was not really a surprise at all. Job growth has continued to moderate. Top line non-farm payrolls were up 236,000 in March. The 3-month average gain is still pretty high at 345,000. That's up from the end of last year, but it's still down significantly from a year ago. In the first quarter of 2022, we were averaging, better than 550,000 jobs a month. So still a definitive slowdown in the job market here over the last year. On the industry detail, maybe a little bit of a surprise with construction payrolls finally falling. I mean, maybe that was sort of always expected to happen, but it finally did happen here for the first time since the beginning of last year. Manufacturing fell for the second month in a row, albeit by a very small amount. Retail was down, although it was up pretty big in the last 2 months. So just a little bit of buyback there. Information payrolls actually gained a little bit, which is maybe a little bit surprising given sort of the ongoing tech layoff announcements that we keep seeing. The gain was small relative to the declines over the last few months, so still not a positive story there. Healthcare, leisure and hospitality continue to be the primary drivers of payroll growth, and that has not really changed. A similar story to last month in terms of earnings and hours. Average weekly hours ticked down a little bit again. Earnings were 0.3% over the month again, which was sort of in line with where it's been the last few months. Year over year, wage growth is now getting close to 4%, the lowest it's been in a while. The household survey, if anything, was maybe stronger than people would have expected. It's probably the more robust side of the report here. The unemployment rate ticked back down a little bit to 3.5% after it jumped a little bit last month, and that was for the right reasons. Labor force growth is still strong. Employment, as measured by the household survey, is strong again this month. So sort of a maybe a bit more positive story out of the household survey, and maybe a bit more strength than we or the Fed would like to see. But all in all, I think it was probably the least surprising report we've seen in a while. Sort of fell in line with expectations.
So we've been looking for reports that kind of thread a needle. We want the job market to kind of throttle back here a bit so that wage and price pressures moderate, get inflation back in. But we obviously don't want the labor market to weaken too much or fall apart, because that would be consistent with a recession. So in that kind of frame, where does this report land?
I mean, it feels to me like it's in the sweet spot. I mean, the labor market's slowing. It doesn't seem like it's crashing too quickly. Maybe you could argue that it could slow a little bit more quickly and that would be okay. But I think, after we saw two sort of upside surprises in the last few months, this was I think a welcome change of pace in terms of what we need to see here moving forward.
So you would say down the strike zone, in the middle of the fairway,
according to script,
according to script,
they all fit.
They all kind of fit, huh? Well, yeah, right. Those are all Zandyisms, I would say.
I would agree.
They-
We had a few wild pitches the last few months, and now
we're back in the strike
zone.
zone. We're
Okay.
back in the strike zone. Apropos to the start of baseball season.
There you
So
go.
the Phils are having a bit of trouble, so I'm not watching at the moment. So they got to get back on track. Okay, that was a good rundown. But Marissa, what do you think? Any gaps there you want to fill in? And I guess also, is your interpretation of the report consistent with Dante and my interpretation?
Yeah, I think it shows a slowing job market, but not cratering. Still strength in many pockets of the industries that we look at. Some of the more interest rate sensitive industries look to be slowing a bit more, which is something we've been expecting, especially given the housing market. We've been expecting construction to slow. And I agree, the household survey side of it looks even a bit stronger. The labor force had a large increase of over 400,000 during the month. The employment population ratio, the labor force participation rate, both rose, sending the unemployment rate down a little bit. And unemployment rates fell for most of major demographic groups. So people are still doing well in the labor market, but perhaps not quite as well as they were 6 months ago. And we combine this with other labor market data we've gotten recently. I think it's pretty clear there is some cooling off here. So I like it. I think, as Dante said, the Fed probably wants to see things slowing more consistently and maybe a little more rapidly, but it's a nice pace of slowdown in terms of, perhaps avoiding a recession while still getting some relief. Wage growth slowed year over year, hours ticked down. So it's moving in the right direction in those regards.
Yeah, maybe this is the time to throw in a couple other kind of data points we got this week related to the job market that seem consistent roughly to the jobs numbers. That would be the initial claims for unemployment insurance. That's a kind of a read on the number of people getting laid off, and also on the JOLTS, the job opening labor turnover survey. That's a month lag, so that's a window on what happened back in February with regard to open positions, hires, that kind of thing. Did you want to just explain those two sets of numbers, and your interpretation in the context of this jobs number, Marissa?
Oh, me.
Yeah.
Sure. So the unemployment insurance claims data is interesting because it actually got revised with this Thursday's release. It gets revised every year when the BLS, or not the BLS, sorry, the Department of Labor, who puts out the UI data, redo the seasonal adjustment factors. They redid them this time, but they actually switched the methodology back to what it had been prior to the pandemic. So the methodology used to be this multiplicative seasonal factor, whereby they would multiply the seasonal factor to the level of UI claims. They suspended that during the pandemic because the pandemic threw everything off. They started adding the seasonal factor instead. They switched this methodology back, and that had the effect of revising up UI claims from, I think it was, Dante, was it the middle of 2021 through present? And so UI claims now are higher, than they were. And the trend shows that they've actually been rising since February of this year pretty steadily. So UI claims in the latest week were 228,000, whereas previously we were looking at a level of claims that was just under 200,000. So the trend now shows rising claims, which it did not before. It had been kind of holding at that 190, 200,000 level for a long time, and they're much higher than they were before. Still not recessionary, still not in a recessionary territory, but definitely consistent with all the layoff announcements that we've been hearing. We've been scratching our head about this for a long time, right? Why aren't these layoffs showing up? If people are getting laid off, why isn't it in the claims data? And now it looks like it clearly is. You see, when you look at it by state, you clearly see big uptick in claims in California and other states where we know a lot of these layoffs happened.
But still, it's kind of consistent with what you'd want to kind of see if you're threading the needle, right? I mean, because 200K, that is exceptionally low, and that's
right.
indicative of an incredibly tight labor market, not consistent with the idea that wage growth is going to come in and inflation is going to moderate. 225K or 230K, where we feel it feels like where we are now, that's still pretty low, right? I mean, by
Yes.
historical norms, kind of sort of want to see something around 250, maybe in the current context, maybe even high as 275. Because Dante, isn't that your calculation of break even?
Yeah, break even's around 270. And I mean, the 4-week average right now is about 240. So I mean, we're getting close to that ballpark, I would think. The recent week fell a bit from where it had been in the weeks prior. So I think certainly creeping up in that direction. And my guess would be we're going to be above 250 here pretty soon.
Although a little uncertainty there because the banking crisis. I noticed that there was a big jump. The big jump in UI was in the week when the banking crisis really hit, and it came back in last week. So I'll be really curious to see, is this is this related to the banking crisis and the fall for the crisis, or is this something deeper, broader going on?
Right, it was up close to 250 in both of the the last 2 weeks of March, and then it came back down a little bit here in the first week of April. So it's hard to know if that's just volatility or if that's a signal of things sort of settling down a bit.
Right. So when I don't want to put words in your mouth, but I look at that and I say, when you see trend lines like that, you go, oh, I'm a little nervous about where the trend is going. Are these UI claims going to continue to go north and ultimately signal recession? But we've been waiting for this to happen. I mean, to rise. So it feels like it's consistent with the script, back to the Zandyism. Right?
Yeah.
Okay.
It had been a head scratcher.
It had been a
why
head scratcher.
This wasn't budging and it was at such a low level.
And just to reiterate, the change, the revision wasn't because they came up with more claims. The revision was because they just changed the way they seasonally adjust the data.
That's right.
Yeah.
That's right.
What about the JOLTS, the job opening labor turnover survey, Dante? Is that consistent with the threading the needle narrative?
I would say it is, but it's a little bit more confusing of a story given some of the different data there. Certainly the job openings data was what we would want to see, a big decline in openings. Back below 10 million was the lowest level of job openings since the middle of 2021. So that certainly is signaling a slowdown in labor demand, which is obviously in line with what the Fed wants to see. The sort of a little bit more puzzling data points were that quits ticked back up a little bit, signaling that workers maybe are feeling still pretty good about what's going on and feeling confident in quitting. And layoffs in the JOLTS data actually fell a little bit from January, which seems a little bit counterintuitive with what we've seen and now in the claims data. Neither of those movements were particularly large, and it's likely just a little bit of month-to-month noise in the data. So I think the big drop in openings is probably the headline there, and the rest of it is likely not a whole lot to write home about.
And just put a number on it. So, and I hope I'm not taking anyone's statistics game number, but 9.9 million unfilled open positions in the month of February. The peak was 12 million unfilled positions, I believe about a year ago, early 2022. And just for context, right before the pandemic hit in kind of 2019, early 2020, we're kind of just north of 7 million. So feels like we're not quite halfway back to where we need to be consistent with a strong labor market, but one that's not overly tight. Is that roughly right? Yeah.
I think so.
Yeah. Dante, we have to remind him, this is, people are listening, on their podcast. They don't see your frowns and your
well,
except if
I
you're
like to
watching
make
on
faces
YouTube.
at you that people can't see. That's
Yeah. Okay. So Chris, you've heard all this. What do we miss? Anything on the jobs numbers or any of the employment related statistics that came out this week and what it means in terms of this narrative about, threading the needle between getting growth down consistent with moderating inflation, but not getting growth down so far that it means recession?
Yeah, it all looks quite good, as Dante and Marissa suggested. We have if you dig a little bit deeper into some of the demographics, you can see that men's labor force participation ticked up as well. That's positive. That's something we had been lagging. So, hard to find any real blemishes here. I guess the one to harp on would be the month-to-month increase in average hourly earnings. Is that sufficiently weak for the Fed? All right, still not where they want it. Yeah, maybe it's trending gradually in the right direction, but maybe it still looks a bit too strong for the Fed's liking, would be my interpretation. Although with the banking crisis and everything else going on, I think that their tolerance certainly is a little bit wider here in terms of how they're going to make the decision. I think the CPI report next week is going to have more of a bearing.
Yeah. So you're making the point that because of the potential fallout from the banking crisis on the economy and labor market, which we haven't quite, I'm sure we haven't seen yet. I mean, because the crisis happened, I think, as Silicon Valley Bank failed on the 10th of March, and the survey, the Bureau of Labor Statistics survey, was done in the week of the 12th. So it would pick up some of it, but I'm pretty sure not much of it. There's a lot more to come, I would expect. And you're saying, look, the Fed got to be thinking the same way, and they'll want to see what kind of impact the banking crisis and had on business confidence and lending and everything else, and ultimately on jobs.
That's right. So I think this is good report in the strike zone. But
even this ref would say, the Dorides ref would say in the strike zone. So
there you go. Maybe not right in the middle of the uprights, but
right, pretty close.
Oh, the uprights. So now we went from baseball to football.
Yeah.
In one sentence.
I don't know.
I like that. I should add that. Yeah. Yeah. Okay. Talking about the banking crisis, how are you feeling about that in terms of the crisis itself, and then also in terms of, are you noticing any fallout here in other data you're following? Chris?
Yeah. So I would say it looks at this point, it looks like the worst of it is behind us, because all the measures that the Fed and others have taken would quash any type of additional contagion. At least that's that seems to be the case at this point. So may still see some additional bank failures, but the likelihood that they would spread to the same degree and cause the same amount of angst, I think, has been taken off the table here. I don't think we've seen the fallout in the data quite yet. I mean, everyone is talking about the lending standards tightening up. And I did see one data point from the Dallas Fed. They do have a banking conditions survey that they collect, that actually was collected after the Silicon Valley Bank failure, and it did look as though there was some tightening on lending standards, particularly for consumer loans, but still early days.
That's the Dallas Fed survey, banking survey.
That's right. That's right. But still early days. So I don't think we've seen the full brunt of this yet. And I think it's going to take a long time for this to play out in terms of the lending standards, the credit crunch, at least a credit shock is going to be going on throughout the next few quarters.
Well, we should be getting the Equifax credit file data for the month of March pretty soon. That'll be interesting to see, because we can see what's going on with the growth in outstandings across different kinds of consumer and mortgage products.
Yeah.
I would expect the fallout to be much larger on businesses, and that's harder to measure real time. But it will be interesting to see what that March data says, if there's any meaning. It was already, the growth that I think was already slowing, right?
Yes, yeah,
because lenders had been starting to tighten in response to an erosion in credit conditions, delinquency rates. But it'd be really interesting to see if there's anything that shows up there.
Yeah, but even that, right? That's
right.
It's partial.
Yeah,
part of the month was
part of the month
susceptible to the bank failures, right?
I guess the other, totally agree. I guess the other channel through which the banking crisis can impact the economy, the first being through lending standards and loan growth and credit availability, that kind of thing, is sentiment. And excuse me. Oh, hopefully I'm not getting sick too.
Oh no.
No, I'm good.
Contagious over Zoom.
I'm doing, everyone's monitoring their body every 30 seconds.
This could be a very interesting podcast.
Yes.
We're going down. I noticed the ISM survey. For
you did. Now you like it.
Well, it was back down again, the services side, that was a pretty meaningful
Yeah.
drop.
Yeah.
And the ISM survey is a survey of purchasing managers, and it's based partially on hard data, but it's a lot of it's sentiment. It's how people are feeling about things. And that took a pretty meaningful nosedive in the month of March. And that survey is conducted through the entire month. And according to the ISM folks, most of the respondents wait to the end of the month to respond. So it would be more fully reflective of, kind of their thinking about what the banking crisis might mean. And that does suggest that, businesses are on edge.
Yep.
Yeah.
Yeah, for sure.
Wasn't it the largest decline since the financial crisis or something?
I think for the orders component of it.
That's right. It was the new orders component.
And I think I'm stealing Dante's analysis now, which as
That's
you
probably
can tell,
Bernard if it's not.
That's what it's
okay.
there for.
Yeah, careful consumer of it. The overall index fell even more sharply in the month of December, and that felt bogus because it just bounced right back up. So I'm not sure, maybe whether this is in the same kind of has the same kind of issues, but we'll see. I guess the one thing it feels like it's saying is people are on edge. If anything kind of doesn't stick to script, they get very nervous very fast. And maybe that's the message here in these surveys, that people are very, very nervous about things.
Yeah. We also got the factory orders for February this week, and they were down, right? So it was already suggesting slowdown even before.
Right.
March.
Although those numbers, I always am hesitant to read too much into, because they're so volatile
Very
month to month,
volatile.
right? Yeah. But you're right. I mean, certainly
Well, it's
consistent.
2
with the-
consecutive months, right?
Yeah. Yeah. 2 consecutive months. Yeah. Okay. We got a few things I want to do during the podcast. One is the game, the statistics game. Maybe we'll do that next. Then I want to take listener questions. So, we've been soliciting listeners to the podcast for their questions. And here I'm soliciting again. Please fire away. We're collecting them, and we're going to respond to a couple, 3 of them, here today. And then I think I want to come back at the end. We haven't done this in a bit. Probability of recession. Maybe broaden that discussion out a little bit. We've been focused on the next 12 months. Maybe we should start thinking a little longer run, but we'll do that as well. Sound like a good game plan going forward? Everyone good with that? Okay,
Yep.
Let's turn to the game, the statistics game. Just a reminder, we all put forward a statistic. The rest of the group tries to figure out what that is through questions and clues, deductive reasoning. The best statistic is one where it's not so easy, we get it immediately, not so hard, we never get it. And if it's apropos to the topic at hand, I guess that would be banking and job market, and released this week by the agencies or trade groups. That would be desirable. Okay, tradition is we begin with Marissa. Marissa, you're up. What's your statistic?
My statistic is 172,000.
In the jobs numbers today.
It is.
Household survey?
Yes.
Okay. Is it related to the labor force?
Well,
Ooh.
no. I mean, yes, it's
Okay.
related. It's related to the
Head fake.
everything's related to the labor force. and the
Okay, that
household
was too
survey.
broad. Yeah.
Yeah.
Well, I was thinking, is it related to job employment or I guess it's well, I guess that's a bad question. Everything's related to the labor force. Is it a demographic cut of the data?
No,
Is it a change in
it is a over the month change.
over the month change? And it's not a demographic cut. What do you think, guys? Anything?
Is it one of those marginal workers, permanent job losers, something like?
Not in the labor, something related to not in the labor
Yeah,
force.
it is something like that.
Is it an increase or a decrease? Did you say that?
It's an increase.
Okay, just checking.
Increase in what? In the
So
marginal
plus
workers?
172,000 over the month.
Yes.
I'm
Plus
sorry. I'm sorry, I missed that. So it's related to an increase.
Chris just said it. I mean, he said a
Oh.
bunch of different unrelated things, and one of
Change
the
in
things
marginal
he's-
worker, marginally attached.
No, No, it's the
Permanent
other.
job losers.
Yes. So it's the number, it's the increase in the number of people who permanently lost a job in March. And that's significant because in the prior month, in February, that number rose by 123,000. So over the past 2 months, that's risen by nearly 300,000, which would be the biggest, consecutive month-on-month gain that we've seen since the teeth of the pandemic. And then you'd have to go back much for, I'm going back and I'm still not seeing it, years and years and years to get to a 2-month number like that. You'd have to go back into like 2009 to see a 2-month increase in the number of permanent job losers that big. So this is also consistent with what we're seeing with the hearing about the layoffs and the increase in UI claims and, the slowdown in hiring and just overall cooling in the job market.
Got to be off of pretty low levels though, right? I mean,
that's true. Yeah.
I mean, it's like,
off
it's
of
got to
low.
still be incredibly low. I would think. No.
Yeah, yes, it is.
Oh,
It
okay.
is. Yeah, I was trying to find it, but I can't find it right away. But
Yeah.
oh,
okay. So you're
I
saying
thought the over the month change was pretty significant. We haven't seen a big increase in that series in a long, long time.
so you think there's information there? You do think there's information there?
I think it's consistent.
with, yeah.
It's just consistent with this other data showing that, yeah, perhaps layoffs are ticking up and the job market is cooling.
Right. Okay. So the number of people who have who permanently lost their job has increased meaningfully over the last couple months. Still low,
That's right.
but it has increased and consistent with these other data suggesting an easing up of the labor market.
Yeah. And this is, the BLS reports why people are unemployed, the reason for unemployment. So the other reasons could be they're on temporary layoff, they quit a job. So this isn't people voluntarily leaving, right? This is basically a layoff, and we haven't seen this kind of movement in that series in quite some time.
Right. I think I bring this up every jobs report, but it keeps I bring it up because it bothers me. The idea that the labor market's well beyond full employment. It just doesn't. If you look at the data, it all is consistent with a job market that's at full employment. The unemployment rate's 3.5%. That's where it's been for an entire year, and that's where it was prior to the pandemic. The the employment to population ratio, it's high and rising. I think it's 80.7%. I hope I didn't take anyone's statistic, but 80.7% for prime age workers, 25 to 54. But that's pretty much where it peaked out, prior to the pandemic. You look at the all of the numbers in the report. It doesn't seem to suggest that we're operating well beyond full employment. Am I wrong? I mean, I don't know that that's consensus view. It's certainly not the view at the Fed. I don't think they view the labor market as beyond full employment, but
Because they're looking at the wages, right?
but even on
You say
wages,
that the wages are the signal.
But they're slowing now.
Yeah.
Slowing, but they're still faster than
Yeah.
historical average, right?
Okay, I'm going to go.
Break even.
This is the moderator's prerogative. I'm going to go next in the context of this conversation.
Okay.
And I got this. This may now be too easy a statistic, and if it is, then I'm going to give you a second one. 3.75%. 3.75%.
Is this the 3-month moving average of
Average
Annualized
hourly
wage growth.
earnings.
Pretty, yeah. But the Q1 annualized wage growth, if I average hourly earnings wage growth, 3.75%. So I don't know. That's exactly where it was pre-pandemic. I mean, we've talked about wage growth and why it was so elevated. In my view, not because of of an extraordinarily tight labor market. Certainly, you couldn't get that kind of wage growth without a tight labor market, a full employment economy. But it goes to other things like inflation expectations. And 3.75% is, I'd say that's pretty consistent with or close to what the Fed would want to see, given their inflation target. So 2% inflation, 1.5% productivity growth gets you to 3.5%. That's 3.75 is within spitting distance. So again, I'd say it's pretty consistent with the idea that the economy is at full employment, but not beyond full employment. Would anyone take significant, Chris, would you take, would you push back on that? Do you think we are well beyond full employment?
I don't think we're well beyond. No,
Okay.
we might be beyond.
Beyond. Okay. And Dante?
Yeah, at the risk of burning another statistic, I mean, we're still adding, over the last 3 months, we're adding almost 600,000 people to the labor force every month. So it's
Yeah.
hard to feel like you're well
That's right.
beyond full employment if you're still bringing that many new workers.
That's that's the other thing I forgot to say. Yeah, exactly. Yeah. Okay. Here's my second statistic in the context of that, because you wouldn't have gotten that 3.75 as easily if it wasn't in the conversation the way it was put in. Correct?
Oh, now we don't know. We don't know.
we don't know counterfactual. That's true.
Yeah.
That's true. All right. Here's another one. This one's harder, but you've got context. Two numbers: 2.43 million, 2.05 million. What do you think those numbers are? 2.43, and it's a change over the year in the context of the
labor force growth.
Labor force growth, 2.43 million. So divide by 12, that's a couple 100,000 a month, right? That's your labor force growth. And that goes to the increase. No one mentioned labor force participation increased again, or maybe I missed it.
I did.
No, you did. Okay. So another increase. 2.05 million. What's that? You got labor supply.
Oh, is it the civilian non-institutional population?
No, it's an increase in labor demand. That's the change in employment plus the unfilled positions. That's
Okay.
labor demand. 2.43 million in supply. This is through year over year through the month of March. 2.05 million labor demand. I'm using a little bit of sleight of hand here because I'm using the JOLTS data and that ended in February. So I just assumed that March is going to be the same as January to get to that number. I think that's a reasonable assumption to make. This is the first month since right in the teeth of the pandemic that labor supply is greater than labor demand this month, in the month of March, on a year-over-year basis. So, I mean, I think that's encouraging, again, in the context of we are threading the needle, here between we want the job market to ease up so that it eases wage pressures, but we don't want it to ease up too much. Okay. Actually, I have a great chart. I'll send it all around to you guys, showing that. Yeah. I'm going to tweet it out probably on Sunday. Don't take it. Okay. Chris, I know
Just
you're
in time for Easter.
Easter
Yeah.
Sunday tweeting about the labor market.
Oh,
Yeah.
is that inappropriate? No.
Just defines the priorities.
It's a bit of an Easter egg.
It's an Easter egg. Right. Okay. Okay, Dante, you're up.
I'm digging deep into the stats that I had on my list here. Minus 0.1.
And it's in the jobs numbers?
It's in the jobs numbers.
It is a percent.
It's not a percent.
Is it a change in an unemployment rate for a specific demographic group?
It is not.
That would really be digging deep, wouldn't it? But it's a change in.
It's a change
month to month.
It's a month to month change in.
Okay.
But there's no units.
There's no unit.
Oh,
It's an
is
index.
it changing that ratio between? Is it changing a ratio?
Not a ratio.
Okay.
It was a minus 0.1.
Declined. Yeah, it declined. Household survey?
No, payroll survey.
Payroll survey.
Is it the diffusion index?
It's not. That was actually up slightly. It's been down a lot. It was back up a little bit.
It was. Oh,
not a little bit.
Quick tangent. Explain that and what that is and what it's saying.
Yeah, so the diffusion index measures the breadth of job creation. It looks at the basically the percentage of detailed industries that are adding to payroll. So a diffusion index, which it was 60.2 in March, that means that 60.2% of the detailed industries they look at were adding to jobs versus 40%, which were losing jobs, with some middle ground there for industries that didn't change at all. It was 57.4 last month, and that was the lowest it had been in a long time. And that was it's been down very large over the last year. So if you look back to February of 2022, that was the peak of this cycle, and it was above 80. which is historically high. I mean, that's, record high for the share of industries adding to payrolls, and it's been falling precipitously. And as you start to get down below 60 into that, sort of mid 50s range, that tends to be the area where you can see job losses, in aggregate start to happen. So the fact that it seems to have plateaued and picked back up a little bit is a good sign in terms of, not seeing things at the bottom fall out of the labor market. It is volatile month to month, so it's hard to read too much into, single month movements back and forth, but certainly something to keep an eye on to see if the, sort of the breadth of job losses keeps spreading out here over the next couple months.
Okay, going back to your statistic, I think I know what it is.
Okay.
Minus 0.1, the decline in hours worked per week.
The aggregate index of hours worked. Yeah. So I thought Chris would get it because I think he actually cited it last month or the month before. And this is the second straight month that it's fallen. So even though we have huge payroll gains happening, we've had declines in average weekly hours, and that in aggregate total hours have been down now for 2 months in a row. So, I mean, it's just another signal that demand here is softening. Even though we're getting job gains, the total number of hours being worked are falling.
Actually, average weekly hours also fell minus 0.1.
They did. That's true. You're right.
34.5 to 34.4, I think. Yeah.
That's right. Yep.
And 34.4 is like we've come full circle because when the pandemic hit, we saw a big increase in hours worked, in part because I think all the people leaving the labor force, people who were in the labor force were working more. And it's mix effects too, given where the job growth is happening across sectors. But it's now come all the way back in. So it's 34.4 is exactly where it was pre-pandemic. Okay, but that's it. So what your point is, look, we saw this increase in employment, but we saw this decrease in hours worked. So the aggregate hours worked, which is jobs times our average weekly hours, that actually declined, which is consistent with the idea that the economy is moderating. The demand here is moderating.
Right. I think you're right. If you look at job openings from JOLTS and you look at, sort of total hours being worked, both of those are signals that demand is certainly softening here.
Yeah. Very good. Okay, Chris, you're up.
All right. So you've mentioned all of the labor market statistics that I had selected. So I'm going to go off script here.
Off script.
And this is a tough one.
Okay.
But I think it's relevant. It's Q1 number. The number is 183.
183,000?
Nope. 183.
183. There's units. There's some units though.
Yes.
No? Okay. So we have to guess the units.
Yes. If I tell you the units, you'll.
Is it job market related?
No.
No.
It's business credit related.
Oh, business credit related. 183 billion.
What's that? 183? What?
Billion?
No.
Banks?
Nope. Not banks. Some other related entity.
Credit
183 businesses. Okay.
108. Okay.
Another B.
183 businesses. Oh goodness.
Something happened to them in the first quarter.
Oh, okay. Do you any idea, Dante, Marissa? 183. Something happened.
Corporations, more specific. 183 corporations.
Oh, announced layoffs?
Nope.
No.
Bankruptcies?
Yes.
Oh.
183 corporate bankruptcies in the first quarter. That's the highest in 12 years.
Really?
Yeah. So obviously SVB, Silvergate, banks that were in there, but there were other corporations, consumer discretionary companies especially, that filed for bankruptcy in the first quarter.
Oh, wow.
So
that's
suggest
interesting.
some weakening.
Yeah. So 183 corporations filed for some form of bankruptcy in Q1.
That's right.
And that's the largest number of bankruptcies, quarterly bankruptcies since when?
Back to 2010.
2010, coming out of the financial crisis.
Yeah, that's right. So,
do you have any granularity on that? Like what industries or
I'm so
just curious. Or maybe tech? It would be tech and banking, I guess.
So 23 were consumer discretionary, 14 were financials, 14 were healthcare, 13 industrials, and then energy, information technology.
No
tech, or tech is one of those categories. No tech?
Tech, unless it's I guess it could, nothing. Well, there's communication services. I think they'd be in there.
Yeah.
but only 4, right? And they weren't very large.
Huh.
So
That's interesting. How could that go back to business formation? Because business formation in the pandemic has been extraordinarily strong. And of course, a lot of businesses that fail. So could it be that what is what's going on as opposed to any kind of, it just feels weird that you'd see, well, maybe not by Q1, I guess you would start to see some stress here. Interesting. What about personal
Yeah.
bankruptcies? That also is released, isn't it, with that data?
Oh, I didn't see that. I
You
think
didn't see
that's
that?
been trending
Okay.
up as well, though.
Yeah.
I think it's still very low, but I
Yeah.
think the trend is up.
Okay.
Part
Okay,
of
we
this
gotta,
could be just a bounce back, right? Because the bankruptcies were very low during the pandemic,
yeah,
right? So maybe this is just catching up,
catching up. Yeah.
right? Finally,
But worth watching for sure. Yeah. Interesting.
early
Yeah.
sign of some stress here.
Yeah. Okay. Okay, very good. Let's go to listener questions. And I know, Marissa, you've been kind of following those. Are there any ones you want to post to the group?
There's only a few, so I have to, again, send a reminder to people. If you have a question, you can tweet them to Mark on Twitter or Chris on Twitter.
At
You
Mark's
can-
Andy. At Mark's Andy.
And Chris, your Twitter handle is?
He's on LinkedIn. He's a LinkedIn.
More on
maven.
LinkedIn.
Yeah.
Middleway Econ on Twitter. So.
Okay. Yeah. And I'm on LinkedIn and Chris is on LinkedIn. And you can also send an email to helpeconomy.com. That's where most of these questions come in because we're running out of questions. I'm going to have to start making them up.
Oh, no.
So let's see. This is a kind of an interesting one. This was back during Jerome Powell's press conference testimony in front of Congress, as he does every time, right? The Fed meets and the senators get together and question him. And I guess I did see part of this. This listener to the podcast was watching this back and forth between him and Senator Elizabeth Warren, and she was sort of
I saw that. Yeah.
going after him, saying you're going to cause a recession, you're going to cause harm to the economy, all these people are going to be put out of a job, right? What else could the Fed, what other tools does the Fed have to, if any, to fight inflation? How do they toe this line between trying to fight inflation and keeping the economy at full employment? Is there anything else they can do other than raise short-term interest rates? Like what would be the alternative if she's saying raising rates this high, this fast is detrimental to the economy? What else could the Fed do?
Yeah. Before I answer that question, maybe others would like to take a crack at it as well. I watched that exchange and I was thinking to myself, how would I respond if I were Jay Powell sitting there listening to Senator Warren, who I respect both of them, a lot. How would I respond to that question? Because she was going after him saying, look, you're going to push the economy into a recession here with your policies. That's going to hurt a lot of people. And, why do that? You shouldn't do that. And I would argue, and Jay Powell said something, well, inflation is bad too. People don't really like everyone hates inflation. We got to get that back in. That causes a lot of damage as well. That was his response. My response would have been that you could have said that. That's true. But the other thing I would have said is, look, I'm trying to keep unemployment as low for as long as possible. And if we don't get inflation in, we may have low unemployment here in the immediate future, but we are ultimately going to have much higher unemployment for a longer period of time. So if your goal here is to keep unemployment as low for as long as possible, the best policy is one to get that inflation rate back in as fast as possible. That's kind of sort of how I would answer that question. In terms of the tools, that's part of the problem and why it's so difficult. They don't have many tools. Mm-hmm. They have a couple. The one is monetary policy, that's interest rates, and that is traditional kind of short-term interest rates, federal funds rate targeting, that kind of thing. Then there's the non-traditional QE, QT to try to get long-term interest rates down. but that's a very blunt instrument, to address inflation. And obviously, a lot of difficulty. The second broad set of instruments is around regulation of the banking system, right? If you can if you want to bring down growth and demand and quell inflation, you can use your regulatory oversight to make it, make banks more cautious extending credit. And of course, that second tool, they didn't need to use at all because we had the banking crisis, in part because they raised interest rates so aggressively. So it's a very difficult thing for them to do. And why threading this needle, kind of the frame I've been using here through this podcast, is so difficult to do. It is literally threading the needle, really, really hard to do because you just don't have the explicit tools to get it done. I guess a third tool, and I'll just throw it into the mix just to try to be complete, but I don't think it has much impact, is through jawboning. Just trying to what he's doing, and all the central bank, all the folks on the Fed are doing, is they're talking tough about inflation. They said, we're going to do whatever it takes to get inflation back in to target, and by so doing, if you can convince people that in fact is what you're going to do, inflation expectations will remain lower, and it's easier to get inflation back in. So that's kind of a third tool they can use and have been using here to try to get inflation in. But again, that's pretty difficult to execute on. It's a pretty blunt tool. Chris, anything you want to add there to what I just said?
I think that's right. I mean, the Fed's tools are blunt, and I would have said communication and certainly the Fed funds rate are their primary vehicles. I obviously wouldn't be this defensive in a congressional hearing, but I would turn it back on Congress and say, look, this is, the Fed is the firefighter here, right? They do what they can with these very blunt tools to deal with the situation, but they're going to cause damage, right, with these very blunt tools. It's not as surgical as you would like. It's really up to Congress to set the stage in terms of addressing a number of other factors that could help to bring inflation down, right? So, good to criticize the Fed. We absolutely should, but the Congress is not helping by allowing a debt ceiling issue to linger, being wishy-washy in terms of energy policies, right? There are lots of other things that could be done here outside the Fed's purview.
Yeah, that's good. That's a good response. Dante, anything you would add?
I don't think I would add, but on a related note, in terms of what the Fed might do moving forward, I don't know if you saw, market expectations swung pretty dramatically on the news of the employment report this morning.
Oh, no, I didn't see that. No,
as of yesterday, it was basically 50-50 about whether there'd be another rate hike in May. And now it's swung basically 70-30 in favor of a rate hike in May. So I'm curious if that sort of fits with what, apparently they think this gives the Fed cover, to go ahead and hike again. I'm not sure that I would have read it the same way. This feels like what the Fed wanted to see, but curious what your reaction is to that.
It's thin trading. It's Good Friday. Equity markets closed. The bond market's trading through midday. So I'm not sure I'd read too much into it. Let's wait, see what it looks like, come next week. And I suspect it's going to bounce around 50-50 here because it is 50-50, in our forecast, our baseline forecast, no recession forecast, we have one more rate hike in May, so it's in there. And they are talking tough, and they've made it pretty clear that it sounds like they've been kind of laying the foundation for another rate hike, and assuming nothing else goes off the rails. So not too surprised, but let's wait and see. I'm sure the market isn't that liquid. That was a great question. Marissa, should we do one more? And then
Sure.
Okay.
This is more of a softer question, but it's related to the one I just asked, which is the job market is so great, right? We come on here and talk about that all the time, how strong the job market is, how low unemployment is, wage growth has been faster than it's been in a long time, despite the recent slowing. So why do people feel so crappy about their personal financial situation, about prospects for their finances? By many different surveys you can look at, right? We look at consumer confidence surveys. this listener was pointing to a Wall Street Journal survey that asked people about their personal financial situation. Most people said they feel worse off today than they would have expected to be at this stage in their life. So if the job market's so great, which is the vast majority of sort of people's financial situation, why do people feel so bad?
I got a lot of answers for that one, but maybe I'll let you guys take a crack or swing at that first. Who would like to do that, Chris or Dante?
I'll start with the data.
Okay.
I always question the data.
Yep, exactly.
Yeah, the surveys.
Yep.
I don't know how reliable they are anymore. So I always take them with a grain of salt. Who's answering these survey questions? How are the questions being asked? You always have to take that into consideration. And there is a disconnect between observed or revealed behavior and survey behavior. So good question to ask why that's the case. I think a lot of it has to do with just people either not being truthful or fully truthful when they answer the survey, or the survey being a flawed instrument in terms of representation. So I think that's part of it. On top of that, I would say there likely is a lot of scarring still out there. People have been through a couple cycles here of really negative economic situations. So I believe that they are more guarded. Even if the labor market is great today, well, what's going to happen tomorrow? What's going to happen the next day? I think that might color their opinions as well of what the future looks like for them and for their children.
Dante?
Yeah, I mean, I think it's an artifact of a lot of these sentiment style surveys where people tend to respond more negatively about their own situation, even if they have a more positive view about sort of the overall economy or the overall labor market. They tend to think their own situation is worse than sort of the average person out there in the labor market. So I mean, I think that's one thing that could be contributing to it. I mean, the other sort of real factor is that certainly inflation and its erosion on purchasing power has had a real impact for some people, right? I mean, wage growth has been strong, but there's still a large segment of the workforce who likely has less purchasing power today than they did a few years ago. So I mean, I think some of that is a real deterioration in how people are feeling about their finances and their spending power. So
I mean, the obvious answer is inflation. I mean, people hate inflation. And I think maybe exacerbating how much they hate it is many people have never experienced it. They go like, what is this? So the last time we've had inflation that was a problem was back in the 70s and 80s, and many people weren't even alive at that point in time. And others, barely remember it. And I think people view, and here I'm stretching a little bit, but I think people view inflation as being unfair. It's like, why am I spending, by our calculation, right, in the month of February, the average American household was spending $372 more a month to buy the same goods and services that they were purchasing a year ago because of the inflation. And they go, well, why? Why is that? I'm getting ripped off here. Someone's taking advantage of me. And then the surveys, I would push back a little bit because surveys are saying different things. The University of Michigan survey, a popular monthly survey, people are feeling crummy. But if you look at the Conference Board survey, another monthly survey, the sentiment is about where it's been on average over the history of the index. They're not feeling great, but they're not feeling, I wouldn't characterize it as feeling crummy. It's just feeling like average. And that just goes to Chris's and Dante's point about the survey. The Michigan survey is focused on people's personal finances, inflation, and also stock market, and also perhaps housing values. They're down. Whereas the Conference Board survey is more focused on the job market, which is, as we've been talking, is good. I mean, unemployment's 3.5%. People are doing pretty well. So I don't know that I'd say by all different sentiment measures, it's not fair to say that people are feeling. They're not feeling. Again, no one's feeling great, but they're not feeling crummy. And then there's, I think, all kinds of atmospherics that play a role. The political environment, that can't be, because you look at the survey responses, Republicans are really, really depressed, compared to no one's feeling great, but the Republicans are feeling really depressed. And that's got to be, the political environment that we're in. So I think it's just a whole slurry of things that have come together to create this kind of noxious brew in people's minds.
They're
Um,
feeling depressed, but they're still spending. They're still
Yeah, they're still spending. Yeah.
the revealed
Yeah.
behavior is different.
Yeah. Yeah. Okay, well, let's move on. There's one more thing I want to do, and that's the probability of recession going forward. And let me ask you this. I've not talked this over with you guys, but maybe I can look for two numbers. Probability number one is the probability that a recession will start in 2023. So the next 9 months of 2023. And then the next one is the probability of recession starting in 2024. How does that sound? Just to provide a little more granularity here in terms of people's thinking. Does that sound reasonable? Okay. And correct me if I'm wrong, but it feels like even if you weren't more pessimistic about the economy in 24 than 23, that your probabilities in 24 should be a little bit higher than in 2023, just because, things
If it doesn't happen in 23,
Yeah,
then
if it doesn't happen, conditional,
yeah.
and it doesn't happening in 23,
Right.
it's got to be a little bit higher than you would think, unless there's some reason why you would think otherwise. That but typically you would think it would be higher. But is that do I have that right, Chris? Do you think
So these are probabilities within those periods. They're not cumulative for the second one. You're saying probability of a recession in 24, independent of 23.
Well, I'd say conditional on 23, no recession in 23.
Yeah, I'm sorry, assuming no recession, but not the cumulative probability.
Not the cumulative probability
within a year and a half.
Because just to give more.
Sure.
I think that's more gives people more context as to how we're thinking about things. Okay, so recession is as defined by the National Bureau of Economic Research, a broad-based, persistent decline in economic activities, kind of down, not 2 quarters of negative GDP, which we got back in the first half of last year, but NBER, National Bureau of Economic Research, defined recession. Okay, let's go with you, Marissa, first. What is your probability of 2023 and probability of recession starting in 24?
I would say I'm at 50% for the remainder of this year. And then if we go into 24, I'm at 55, somewhere between 55 and 60.
Okay. So that's up from where you were for 23. You were kind of at 45, I believe, something like that.
I think, I was a little south of 50 before the banking crisis, right?
Okay. All right. So you're thinking this is going to take a little longer to play out, that if we're going to have a recession, it's just not going to happen here in the next few months. It's going to play out further into the horizon in 24.
Yeah, I'm a little more worried that next week will be interesting when we see CPI. I'm getting a little bit more worried that sort of core services inflation is going to take longer to budge. It made good progress and then it kind of stalled over the last 3 months. If you look at the 3-month average, and the longer that takes to get under control, and the Fed has to play this thread the needle game between the job market and financial conditions and inflation, that's just a higher probability that something goes wrong down the line.
Here's the thing about the inflation outlook, monetary policy, and recession risks that I don't quite get. Suppose inflation, and let's focus on CPI inflation, consumer price inflation. It's 6% on the nose year over year through the month of February. It feels, and you can correct me if you disagree or take a different perspective, but it feels like we're going to come down pretty fast here, given so-called base effects, comparisons to this time last year when inflation was at its peak, given the slowing in the cost of housing services, because we know rent growth has gone flat to down, and that's going to translate through with a lag. Feels like goods prices are going to start to come in, new vehicle prices. So it feels like we're going to go from 6 to 3-ish here pretty quickly, and by the end of the year, we're going to be at 3. The Fed's target for CPI inflation, and here I'm making this up, but I think it's right, is about 2.5%. Core consumer expenditure deflator, different measure of inflation, that's 2. but because of measurement different CPI is probably 2.5. So why, do you really think the Fed is going to be on the warpath over 50 basis points, getting from 3 to 2.5? I just don't see it. So I feel like it can state with confidence we're going from 6 to 3. And once we're at 3, they're going to be much more relaxed and leisurely about getting it back down. They want to get it back down. They're going to keep monetary policy tight. I don't see the funds rate coming back down, quickly, but I just don't know why they would need to or feel compelled to continue to press on the brakes, raise rates even more, which is, I think, what you would need to get a recession in 2024 to get that inflation the last mile back to 2.5%. Does that resonate with you? What I just laid out?
Are you arguing that they should stop right now?
Well, if I were king, I'd stop right now. But if it's a quarter point, no big deal, because as Dante has pointed out, that's already embedded. It's okay. Another quarter point, you bring the federal funds rate target to just over 5%, and then I think they're going to pause. And then I'm saying, given the inflation outlook, given the economic outlook, I don't see the compelling reason why they need to start raising rates again later in the year going into next. And then if they don't raise the rates, they have to raise rates again going into next year. It's much more difficult to construct a recession scenario in 2024. Sure, things can go wrong, and that's why the probability should rise in 24 relative to 23, because who knows what's going to happen with stuff, just random events. But in terms of, things that we can see and account for, monetary policy is a thing that would seem to me would have to push us in. The Fed would have to be more aggressive and start raising rates again for us to go back into recession in 2024. What do you think? No?
But what if, so no argument that we're clearly on a downward trajectory with headline inflation because of those things you just mentioned, but we could get another energy price spike. OPEC is cutting output here. If the Fed has said they're very keyed in on wage growth, if that kind of super core stuff doesn't budge, even if you get all the other rent, food, even energy falling, do you think they're going to just ignore that and let that be?
That's my let it be in the sense that they believe that it is going to continue to moderate, but it doesn't have to get back to 2.5% like now. I mean, why do I need to push the economy into recession to go from 3 to 2.5?
I guess I'm saying, what if it doesn't really moderate? What
well,
if that
my working assumption is the labor market's weakening, the economy is slowing, unemployment's notching higher. That's kind of that's kind of the forecast. So you get to the end of the year and you're looking around, you're saying, why do I need to push this economy even more? It's already on the edge of recession. It's already weak. Why do I need to push this economy even harder to get, that last mile, to get that 50 basis points in a few months? I mean, if I'm going to get this over the next 12, 24 months, I'm okay with that. Now that, of course, that's just me. The Fed, maybe, who knows what they're thinking and, how they're approaching it. But that, I would think that they would be much more relaxed about getting that last 50 basis points. But anyway, Dante, what's your probabilities?
So I think the last time you framed this as 12 months, I was at 50%. I think if I'm thinking just in 2023, that's probably 40%. So I think it's a bit lower than that. And I think I don't think I would go higher than 50% still in 2024. For a lot of the reasons you just mentioned. I don't see the Fed pushing too much higher at this point, given everything that's happening, given the improvement in the labor market, given what is likely to be improvement in inflation here in the second half of the year. So I think I'd stick at 50% for 2024.
Yeah, so 40% in the remainder of 23 and 50% for 2024. Okay.
Yeah.
Okay, you just heard my kind of mini rant. Did that resonate with you?
Yeah, the only question the thing that I ask myself is, we know the labor market's slowing, right? Even if the Fed pauses, it's hard to know how much further the labor market will slow, right? I mean, if the labor market keeps slowing, even if there's a pause, we could still end up in a recession in early 2024, even if the Fed does what we think they should do and sort of take the foot off here pretty soon. It's hard to know how much damage will continue to happen or how much that slowing will continue, even if rate hikes stop and we just are living in a high rate environment here for the rest of 2023. So we've gotten the thing moving in the slowdown direction, but we don't know how far it's going to go, even if they stop hiking rates.
Yeah, that's fair. Although I'd say with a reasonably high degree of confidence that one, inflation's coming in. I think we're going 6 to 3. I feel, there's things that could derail that, but I feel pretty strongly about that. And it also feels like the labor market's going to slow. I feel pretty confident about that. In the context of the high rates and the banking crisis, we're going to go from 300K per month on average. I think we're kind of north of that right now, 300K per month on average, underlying, abstracting from the vagaries of the monthly data, down to something that's 100K or less. I feel pretty confident about, we're going in that direction. And on oil prices, there I'm less confident, but I'm making an assumption that I think they're going up, but I don't think they're going to go back up to $100 because there's a lot of excess capacity, spare capacity now out there in the global oil markets, given all the production cuts by OPEC and the forced cuts by on Russia because of sanctions. But that is an assumption. So given that reasonable, in my mind, reasonable confidence around those dynamics, I say to myself, why would the Fed raise rates? Feel compelled to raise rates more, and if they don't, then the odds of recession odds are in 24 are very high, but doesn't feel like it's extraordinarily high. But okay, so you're on board with that. Okay, Chris, go ahead.
You're sitting down.
Yeah.
So
by the way, do you want me to give you my odds first so that you can react to that?
No, I'd like to give you mine first so you can adjust yours.
Okay. Fire
So I
away.
think I'm pretty compelling.
You can correct yours.
Yeah, correct mine. Yeah.
I'd say 45% for 2023.
Oh, okay. Interesting.
So do agree in terms of the timing there, but 67% for 2024.
And 67 is strategic.
Well,
right?
Yeah.
Kind of strategic.
Yes, kind of strategic.
Because
I debated could be 70, but the 7, that calls a lot of attention. So
no, 67 is, well, it's strategic because you would put
the baseline forecast would have to change if that's the case.
That's right. Because our rule of thumb is for a big change in the forecast and adopting a recession of any flavor would be a big change, and we need to be very confident, and very confident is a subjective probability of more than 2/3. If you go to 67, you're effectively saying you would put a recession at some point in 2024 in the baseline forecast, our baseline forecast.
Although we already have a little bit of a recession.
What does that mean?
50 basis point increase in the unemployment rate.
But we still, but we have 1% GDP growth. We have unemployment.
Fair enough.
Yeah. Okay. Fair enough. This is an important point. It's a really important point.
Yes.
You're saying this is kind of an artificial line between an economy that's on the edge of recession and an economy that experiences a modest recession, which is what you would anticipate. So it's a kind of like a faux point of demarcation. It's a bit of a parlor game, is what you're saying.
Yes, I'm not. Choosing 67%.
Yeah, that's fair.
Is making a statement, but it's not as strong a statement as if I went to 75 or 80. Then it's clearly suggesting deeper recession. No ambiguity, right?
No ambiguity in your mind. Yeah.
So.
But Marissa's at 55, and she, correct me if I'm wrong, Marissa, you would not put a recession in the baseline forecast for 24.
No, I wouldn't.
Yeah.
I like what the baseline looks like now.
Yep. Okay. All right.
Skirting recession.
Well, you heard my mini rant. So how would you respond to that?
I would say all well and good. I don't know about the 3% by end of year in terms of inflation. Maybe it's 3.5. I won't quibble with that, but I don't think the Fed is going to hike aggressive. I do agree with your assessment there. I think you might be putting a little too much or too little weight on the credit crunch from the banking crisis. I'm really concerned that we haven't seen the real effects of credit drying up for a lot of businesses, and that inevitably will cause some pullback in activity. I think that does take a while. I don't think it's immediate. I think it's when loans come up for refinancing, and the banks are also adjusting. Right now, they may be flush with capital again. They've gotten their liquidity positions back in order, but still they're going to be facing a lot of earnings pressure going forward. So I expect that's going to weigh heavily. I also am expecting another shoe to drop in terms of delinquencies and losses, right? We had only started to see auto delinquencies, credit card delinquencies starting to tick up. I think we're going to continue to see those types of trends in the future, and that's also going to lead to some pullback in credit and spending and investment. So that's the rationale. I don't think we need the Fed to cause the recession. As long as the Fed doesn't actually cut, I think they're already putting a lot of pressure, given the long and variable lags of monetary policy. We're going to be feeling these effects over the rest of this year and into 24.
Right. So even if the Fed, say they raise the rates a quarter point in May, the funds rate, it goes to a little over 5. That's a terminal rate, doesn't go any higher than that. Even with that, given what's already in train.
Yep.
Recession.
That's a lot.
There's a lot. Yeah. Okay. Okay. I'm at 40% with Dante on 2023, and I'm at 50% for 2024. So very consistent with the same kind of logic as Dante had. It's hard to see recession. Well, hard is not the right word. Less likely we see a recession in 23, just given, this is March and we're still creating 236,000 jobs. Unemployment's still 3.5. It could happen. Something would have to go off the rails. We'd have to get $100 plus oil for a couple, 3 months, which again is not inconceivable, given things, but not what I would consider likely. But 24, the odds do rise, just simply in part because that's a long period of time, and to say nothing else is going to go wrong, consequences over the next year and 9 months that's saying a lot. I mean, things can happen. I will say though, I do think some underlying weights on the economy will lift as we move into 2024. So, for example, real disposable incomes of people are now turning positive again because inflation's coming in, wage growth isn't coming as fast. So people's purchasing power is no longer eroding like it was a year ago when inflation was taken off and wages were lagging far behind. So consumers should, get some solace from that, particularly lower income households, some benefit from that. The other is housing. So housing, under tremendous pressure, given the run up in mortgage rates back 6-9 months ago, a year ago, and that undermined affordability and demand collapsed immediately. Home building fell sharply, and it feels like we're pretty close to the bottom, I think, in terms of home, if we're not already at home sales, pretty close to bottom in terms of construction. House prices more to go, but in terms of its economic consequence, I think housing goes from being this major headwind to growth over the last 12 months, year, to kind of going more neutral with respect to the economy. So it does feel like there are some things out there that may actually help to support, the economy as we make our way into 24. So it's not all negative. But anyway, that was a good discussion. So we'll definitely come back to these probabilities down the road here and use this new frame of 23 and 2024. Okay, with that, anything else, guys, you want to bring up before we call it quits? I did another body scan, and
we made it. We all made it.
We all made it.
No one collapsed.
No one collapsed. I
Pretty low
hope
bar.
everyone has a nice holiday weekend. I know it's Passover and Easter, which is, I think, rare for them to line up like that, but so it's a very important holiday weekend for lots of people. So with that, you guys taking off the afternoon? No, not you guys. You're always working. So yeah.
We actually have the afternoon off.
Do we really?
Although it seems some people forgot because we have meetings on our calendar.
Yeah, I got plenty of meetings.
Yeah.
Okay. But with that, we're going to call this a podcast. Take care, everyone.